In this video, I'm going to be going over failed auctions, how I trade them, the nuances of it, the order flow inside of them all, how I can potentially pre-anticipate some of them, and certain features that I generally like to see before I take a trade on them in relation to them, and using my invalidation as well, based upon the order flow side of things. So, to begin with, a failed auction is generally you want to have an SR level, in my opinion, to find the best ones. It's generally an SR level which has been tested multiple times, okay, before then seeing a loss or reclaim of the level, as we're seeing here, for example. Okay, so you've got your support again, before then being tested, lost in this case, lost, okay, before then seeing a reclaim and then seeing a decent move to the upside. Now, yes, the level has to be tested multiple times in order for this to occur because, well, generally what I found is when people see that, when you see the break of the level, so like you've seen here, support, right? When you see the break of this level, a lot of people are pre-anticipating this to be like a massive actual break of the range to the downside. So people are sometimes actually going to be preemptively shorting the move down here, and it just generates the greater likelihood of potentially trapping traders when you have such an obvious SR level, in my opinion. So just bear that in mind. But yeah, a failed auction, you generally want to be spending a little bit of time below this level, or above. In this case it's below, but generally you can also see them above. When you see a failed auction come above a high, for example, spends like in my opinion, half a day, few hours a day even, is really good timing them before seeing a move back and generating a move towards the other side. These moves are generally really bullish or really bearish. When you do see them, I really do expect follow through to the other side of a range. In this case, it didn't actually happen, but I'll discuss this move in a second, but more so focusing on this concept down here, because what you end up seeing is a very common pattern that I tend to trade in relation to swing failure patterns. I'll get into the common way to trade them as well, but this is just a very basic way to potentially sometimes preempt or pre-anticipate a failed auction actually going on. So you can see here we've got this actual range going on here again, for actual sakes of demonstration. You can see this was actually going on for 20 hours, what, 21 hours before you saw the actual move in the range or whatever it may be. But what you'll generally see, and what I generally like to see, is a initial low put in. So you break the range, that key SR level, you break it, you then put in an initial low on the chart, which is this low here, which I've highlighted. You then end up and spend time going sideways for, in this case, 20 hours before then swing failure patterning the low and sending it to the upside. Now, that's all good and all, but how can we actually anticipate a swing failure pattern or this move to actually occur, and so on and so forth? If we head over to exo charts, I mean, this is actually what I was looking at earlier. So when you have this is that exact same level. So if we'll just draw this out really briefly, okay. So this is the sixth. Yep, this is the same one I'm looking at, right? You have the exact same, this is the initial lows being put in on the chart, and then you've got the swing failure pattern here, which then leads to moving upside down. I've seen this so many times. It's such a common occurrence. But when you first of all break the range to the downside, what you generally like to see, or what I like to see, is this increasing in liquidations, okay? Because generally when you see an increase in liquidations, it means that, if you don't have them, it means that you're going to, prices generally needed to actually fall a lot further to actually liquidate a lot of people, therefore decreasing the likelihood that you're actually going to see this type of failed auction price action. When you actually see them actually occur really quickly upon that break of the key SR level, like you do in this case down here, I'm referring to the FPBS, right? 1.2 million, 3 million. When you see a ton of them coming in like that, it generally recognizes that we might not need to actually head lower in order to generate the move needed to come back into the range and move a lot higher, in this case at least. So you generally want to see that, in my opinion, upon the break of the range before even anticipating this failed auction. But you then put in the initial low, you then go sideways, and this part, I've discussed this probably before, but when you go sideways and bringing this towards these failed auction type of things, is where you want to be actually using your order flow analysis to kind of decipher whether you want to be taking a long or not. Now, I'm going to be using the dynamic profile tool. So again, over here on the left hand side, dynamic profile tool, I mean, I got a hotkey set up on my keyboard to enable it if I need be. So what I'm going to do is take it from after the initial lows put in, okay, so this initial lows here, take it from afterwards, okay, and make sure, you want to be making sure that the initial low is being put in, and you want to be taking essentially a pool of price action thereafter, okay. And what you want to be looking for is essentially new longs or new shorts positions opening. What is going on within this sideways piece of price action, okay? And you can be deciphering this information through just the use of this one tool here. Okay, in this case here, for example, you've got any form of positive opening, CVD, and any form of positive open interest. That means there's more new longs opening. I mean, you can decipher it through this, but also if you just zoom in, let's enlarge in this. I prefer to use the dynamic profile tool, but you can actually see, okay, from this point onwards, you might have seen, have you seen an increase in CVD before the low is then swept? Because if you have, for example, in this case, if you've seen a lot of new longs, and I'll go through both scenarios for you here because I think they're both really important. If you've seen a ton of new longs opening, okay, with from the initial low being put in, it just offers a ton of liquidity opportunities to stop them out upon the swing failure pattern of the initial low before sending price in the direction people had initially intended, or these people who had newly longed initially intended. Okay, and if you do see, initial low put in followed by a lot of new longs opening, so new longs opening, and this isn't the most obvious or extreme case of that where you see a ton of new longs opening, but if you did, well, then that's when you can pre-anticipate a swing failure pattern and get in on a swing failure pattern before actually targeting not only the higher the range, but a larger move to, or at least the high, I would say at least the higher the range, okay, before seeing a decent move to the upside. Alternatively, for example, if you see the other end of extremes here where you've got the initial low, you then take a the dynamic profile tool, whatever it may be, and you see that there's actually a increase in or decrease in CVD, but an increase in open interest. So you've seen new shorts opening from this point onwards after the initial low. I wouldn't anticipate for a swing failure pattern because that means there isn't much liquidity to be taken. If there's a ton of new shorts opening and you're looking for price to take the low, that's only going to benefit those new shorts. I'm looking for something that's not going to benefit that either end of the extreme. In this case, if in this case it's swing failure pattern, but on other cases it might not swing failure pattern. It might just dip a little bit before then seeing a rise to the upside. I won't go into the complete nuances about this, but the reason it wouldn't take the low is because a lot of people who have been shorting might have their take profit below there, and that, in my opinion, would just benefit them too much. Therefore, it would be less likely to occur. Whereas if you're just waiting for a slight dip in price before then seeing a rise, the difference between the two is if you're looking for, in this case, there's a lot of extreme longs open and you're waiting for a swing failure pattern, it gives you such a good entry, okay, because I've seen it time and time again occur, and I'm looking for just a simple entry below here. Now, when you see a ton of shorts opening in this case here, I wouldn't be looking for the swing failure pattern. I'll just be looking to long upon the reclaim here of the failed auction level. Okay, so please bear that in mind. I'm not looking for a swing failure pattern in that case. I'm looking for just the reclaim or the move above, and I'm using the volume sweep by Leviathan for these volume spikes. And generally, people are always asking me, what is a reclaim? And I'm going to talk about this in a second as well. The reclaim, in my opinion, is simply just seeing volume coming into the level or being broken past this level here, or the key SR level I'd mentioned before. Seeing that volume coming again, just simple volume shading, so volume spike in volume, as I always refer to on a continuous basis. When I'm seeing that, that's a trigger for me to enter. Now, so first of all, when you see extremes in this case where you're seeing a lot of longs opening, look for them to be stopped out before the move they initially intended, okay, gives you a nice and simple entry trigger down here. Now, if you see this other way, you're going to be thinking, well, this isn't really what you're looking for. Well, I've seen I learn a lot of this on my own. Let's just put it that way. Everything basically is on my own. And if I just put this all the way up to here, yes, it's cool. You don't know where you're going to be targeting, whether it may be, let's say you're targeting this order block zone here. Your risk to reward in this case is 1.4R, even if you get in that, 1.2, 1.3, 1.4R, around there. But rather than having your invalidation all the way below the low, what I would do is treat this down here as a mini range, okay? I would, rather than having my invalidation all the way at the swing low, I would take a fixed range tool of, again, that piece of consolidation before the break in the range. And generally, I would have, for example, my invalidation below the point, just at where the point of control is. Because if you're losing this point of control after you've actually, you've seen this break of the range, why would I have my, invalidation all the way down here when a sign of weakness already would be losing this kind of point of control of that mini range already? So I really would be looking at that, to be honest, to use my invalidation as, rather than actually the swing low of the range. Very common feat is actually using the point of control of any sort of mini range as your invalidation, because then that signifies a larger drop in the range, or swing to the other side in this case. Another thing you can be doing, okay, when you're trading these failed auctions, because a lot of people always say, the typical thing I always see for failed auctions is wait for the reclaim, wait for the dollar back test, and then invalidation below the low. To me, I've tried that in the past. I've done the very common features of this, and it's just not worked out the best for me by any means. Validation is too big. You're not increasing your R multiple. It just doesn't seem the most, in my opinion, smart or clever thing to be doing. Because I'm just risking. I don't need for price to come all the way down here to invalidate my idea that this is a failed auction trade. So you can be using the point of control. On the flip side here, you can be going over to here. And this is more of an advanced thing, okay? And I've mentioned this before, but it's really, really powerful. And what that is when you see the failed auction, let's say you see the break of the range, regardless in this case, what I'll be doing is, and you missed a swing failure pattern, for example, in this case, and you've recognized that it's a failed auction, but you're like, I don't know where to get in, my validation's too far away, whatever it may be, is I would take a dynamic profile tool of this uptrend here, for example, and what you can be doing is, in this case, it just completely shoots up, but in this case, I would be looking for, okay, where have the majority of longs open from, okay, and using that as your invalidation, similar to the POC, but this is actually, in my opinion, better, so I'll draw this out for you really quickly on TradingView. I think this is really important to kind of get a grasp on. So let's imagine price, we've broke down of a range, you're going sideways, okay, and then you're waiting for, you see the breakout, okay, of this potential failed auction, and you're like, let's imagine we're here, where do we want to long? Okay, so just for example case, this is your range of the failed auction, right? You're within the range, and you then see that break of the range, okay, and you're thinking, well, I want to enter now, but we're too far away from the swing low, wherever that may be. Where am I going to place my invalidation? Well, what you can then do is take the dynamic profile tool from, I would say from this low up to this local high, and decipher, okay, where have the majority of longs opened on this specific leg here? Okay, on this specific leg here, where have the majority of longs open? And it might give you like a profile as such. If I just draw this out, let's just imagine this is the profile, and you've seen on the right hand side, you've seen a ton of new longs coming in here. Okay, and then below that it's really thin and there's nothing else going on. I appreciate this isn't the best example, but I'm referring to like a dynamic profile tool, where you can see, for example, there's a lot of new longs opening at this exact price level. So rather than having the idea of, I'm going to long around here, invalidation below the low, target highs, right? I would rather have, okay, invalidation can actually be brought up really significantly towards where these new longs have been opening from, because then if these new longs have been lost in price action, I would be then expecting the swing low to be taken. So for me, failed auctions and the way I benefit off of them are two ways, really. The first way being that swing failure pattern, generic pattern, where you see a ton of longs built up, for example, a ton of shorts on the flip side, stop them out, give you a really simple trigger entry before then seeing a move to the upside. But on the other side of it, there is that move where I don't get in on the swing failure pattern and I actually recognize it a bit later on, and I then can use the order flow, point of control of that mini range, new longs or new shorts in this position, new longs in this case, where are they majoritarily opening from, as my invalidation to increase my risk to reward. A lot of people are going to be doing this, and it's just not as lucrative a trade, in my opinion. It's actually really, really not that good, because your R multiple is really not going to be that great. It can be profitable, of course, but generally I found it much better to be using the point of control or the majority of positions on your side, where have they been opening from, and using that as your invalidation is really quite, again, no one really taught me this, but I just had to go through and gauge for myself where to be looking at this stuff from. So use that to your invalidation. You can be looking for those swing failure patterns in that case to be really good. We'll go for a few more examples just so you can get your head wrapped around this. So bringing it back to this case here, actually, we just discussed this piece of price action here, and it didn't seem too much of a move. It made a lower high before then rocketing back to the downside. But then beyond this, what do you then have again is another potential for a failed auction, and this is one I traded myself. I won't get into how I did that specifically, but the aspect of this would be, you got a low support, again another level of support, before then having again. Does it look familiar to you? It should do, because I've just discussed what I really commonly see within these failed auctions. You have the key SR level, lost, range, initial low put in before then seeing a move to the upside. In this case, it's fairly simple again, because you can see if we just head over to the XO charts, where is this? And this is the one we're looking at here. Okay, this one might be a bit more simpler to basically adjust. And look at this. So if we just take our dynamic profile tool, take it to all this way. And what we got here going on, I have to go into a lower time frame to decipher this. So there's a lot of there's a lot of shorts opening in this case. Okay, so you've got a lot of new shorts opening in this case. So you can see here. So again, always what you want to be doing is deciphering the data. Let me just mute this. Deciphering the data coming in. Okay, from the initial low being put in on the chart, and therefore afterwards. If you see a lot of new shorts coming in this case, I would not have anticipated a swing failure pattern. Obviously, when you get it, you do end up trading it. But let's say you were a bit late to the party, you could have entered upon the reclaim of that range there and using your invalidation as such. Because look, so if I just take my dynamic profile tool again, initial low afterwards, look at the CVDs decreasing drastically here, and the open interest increasing. This is showing me there's new longs coming into the market. Okay, if there's new longs coming into the market, I'm happy to be looking, or new shorts coming into the market, apologies, then there's a greater likelihood of actually ending up squeezing them overall. Okay, so let's talk about actually how this would have reclaimed this level and how we could have traded that using what I was discussing earlier. Okay, because you might just say this is a general reclaim or whatever it may be, but let's say you saw this move up and you entered late. Let's just take a dynamic profile tool, like I said, from this low. That's the fib tool, dynamic profile tool from this low up. And this is where it can get a bit tricky, but it's because it's really down to your own discretion as to where a majority of longs are opening on this move, for example. What I'll do, you can even do this, is change this to just short versus long new. Okay, and you can see down here where the massive, real big spikes are really coming into play. You've seen this move up. I would say to myself, if you lose this level here, right, where this, it's fairly thin. I mean, obviously you've got this one up here, but this is too high up in my opinion. You've got this fairly big spike here where it starts to really, a lot of the base of them have been entering from. I would say if you start to lose this initial one, you're likely to lose the last one. And you can be using this zone as your invalidation, which is 25.35. We just go back to XO charts, trading view, 25.35. So let's say you see the reclaim. 25.35 is your invalidation. Rather than having the swing low, it just really greatly increases your risk to reward. Obviously, if you're trading a swing failure pattern, it makes it a lot easier for you. In my opinion, trading a swing failure pattern. But obviously, trading the reclaim, the biggest thing to get from this is that I personally, I would never end up doing this, because it just, the skills I've got, it just doesn't make sense to place my invalidation below there. If I can recognize signs of weakness going on within the chart before the failed auction or the swing low is tested, it makes sense to do that. So hopefully this is making a lot of sense to you. Okay, on the flip side, so for example, this is like looking for a lot where the majority of longs been opening in this trend and using that as my invalidation, or either that or the point of control of this mini range. Okay, well, it's a similar location, to be honest, those two things, but you can look at both. On the flip side, you're looking at longs, but let's say, for example, you're at the high of a range. We've got our SR, this is our SR level. You've tested it a few times. You then see this, movement above, and then, you come back below. In this same case here, so this failed auction here onto the upside to look for a short trade, I would be simply looking for the majority of, where the majority of shorts opening on this leg here, okay, or using the point of control. Okay, just taking a fixed range pull out of nothing there, but a point of control of this kind of mini range here. Where's that going to be my invalidation rather than the swing high or low? Really start getting in the habits of doing this. It would increase your R multiple and such. Again, for the execution standpoint of things, I'm simply entering using the volume, spikes in volume. I'm glad to enter upon that because I know where my invalidation is. Your trade should be sourced upon your invalidation. The way it works for me is, I see this all put in. I then see this level lost again. I see that spike in volume. I'll see, the spike in volume on XO charts or trading view or whatever it may be. And that's when I'm then going, okay, where's my invalidation on this trade? Point of control of the mini range, or where the majority of shorts have entered on this specific downwards leg. That's my invalidation. Calculate the position size and get in, rather than just going for this. It just it still might be profitable, but this just to me something like this would end up working out a lot better in terms of just like your overall risk to reward and increasing your final profit line at the end of the day, or your bottom line at the end of the day. So thank you. Hope you enjoyed.